Jimmy Donaldson runs the most subscribed YouTube channel in the world, yet his media operations recently lost over $100 million. Publicly, 1 billion monthly views suggest a source of infinite advertising wealth. Internally, his 2024 media division financials show that his content is actually a massive financial liability. This chart breaks down the 2024 media balance sheet. While revenue reached $246 million, the cost of production and operations created a loss of $80 to $100 million. While a traditional studio would consider a 9-figure deficit a failure, these media losses are the foundation of a new $5 billion corporate structure. But maintaining this massive scale requires constant reinvestment. A standard main channel upload now costs between $3 and $4 million to produce before it even hits the platform. For his Amazon series Beast Games, Donaldson exceeded the $100 million budget provided by the streamer. He spent over $15 million on the first set alone, and $14 million on a custom city, covering tens of millions in overruns with his own money. He chose to absorb those costs rather than lower the production quality. He claims that delivering this level of spectacle is required to prove that YouTube creators can succeed on traditional streaming platforms. He manages his entire media division as a loss leader, prioritizing audience reach over direct profit from his videos. Feastables Industries is no longer just a production house. It is a consumer packaged goods conglomerate. To understand why, consider the cost of acquiring customers. Traditional chocolate brands spend large portions of their total revenue on advertising to convince people to buy their products. Legacy brands spend 10 to 15% of their revenue on ads. Feastables spend 0%, leveraging 372 million subscribers as a free marketing platform. This drove $250 million in sales in 2024, generating $20 million in profit, with margins double the industry average. Using video content as a free marketing engine is how he flipped a digital audience into physical retail sales. His first attempt at this model was MrBeast Burger. It relied on ghost kitchens, where third-party restaurants were paid to cook and deliver the food. The model failed due to a lack of quality control. Reviewers described the food as inedible, leading to customer dissatisfaction and lawsuits between Donaldson and his operating partners. That failure forced a shift to a retail-first strategy. With Feastables, he abandoned delivery apps and focused on a vertically integrated supply chain he could control directly. Feastables is now stocked in 30,000 retail locations, including Walmart, Target, and 7-Eleven. By 2026, that footprint will exceed 50,000 stores. Controlling the physical shelf space is what allows the business to turn internet fame into actual enterprise value. These retail margins have attracted interest from private equity and institutional investors. A Series C funding round recently raised $500 million. The capital came from institutional backers like Alpha Wave Global and BitMine Immersion Technologies. This investment gave Beast Industries a private valuation of $5 billion. Investors are valuing him as a CEO who is trading short-term cash flow for dominance in the global snack market. But there is a specific risk in this model called key person dependency. Unlike legacy brands with diverse product histories, Beast Industries relies entirely on the reputation of one individual. The Lunchley scandal demonstrated this risk. Donaldson partnered with Logan Paul and KSI to launch a meal kit, but the venture faced immediate backlash regarding quality control and his choice of partners. When consumer trust fractured, the impact spread to his other brands. Sales of Feastables dropped as parents began boycotting products tied to the creators involved. Beast Industries is a conglomerate where the primary asset is the personal reputation of Jimmy Donaldson. If that asset loses value, the entire $5 billion structure is at risk.